Hey, what is up, guys? Stock market is at new record high, but I would argue that now you should be more cautious than ever before. In this video, I'll explain why we are in the stock market bubble, and Howard Marks, one of my favorite investors, will give his own opinion why you should not invest right now. Stock market and economy continues to grow in a very fast rate. It seems like S&P 500 reaches new all-time high every single day. Today it reached over $3,335. I believe this is the time where you have to be more cautious where you invest your money. Stock market forms a parabolic shape, and investors' behavior is very irrational. Investors act like there is no price is too high. Just buy the damn stock and some other fool will pay you more money in the end regardless of the price. The same behavior investors had during 2000's dot-com bubble. They were literally buying any internet stock with the .com in the name regardless of the price. Similar situation happened in 2008 housing bubble. For real estate market, there is no such a thing as prices too high. With 2020 hindsight vision, we exactly know what happened there. Housing bubble burst, stock market plummeted, it lost 50% of its value in just a matter of 1 year. If we look at this current situation, we are in the longest stock market expansion in the history. We are in 11th years of this bull market run. Probabilistically speaking, end should come soon. As Howard Marks said, if we are in the bubble and prices are too expensive, it does not mean that market will drop tomorrow. It might take like months or even years for market to realize the true value. Investing is more of an art than science. For the past few years, this market was not driven by corporate earnings, but it was driven by liquidity. Fed consistently printing billions of dollars daily, and most of that liquidity goes into the stock market, regardless of the price. I remember like 3 or 4 years ago, Apple stock was trading at around 10 earnings multiple, and the price was over $100 a share. Despite the fact that Apple announced publicly that they are cutting projected sales, Apple stock still skyrocketed. Now it's trading at around 26 earning multiple, while the price is over $300 a share. So earnings did not really do much, they did not really increase, but the stock made a threefold since then. Now the question is, how does that make sense? Is there any rational behavior here? I would say no, it does not make sense, and investors act irrationally. This video is presented by DueDex. DueDex is reliable and trusted cryptocurrency exchange with up to 100 levered swaps. It has a new and unique feature where you can amend your order price by dragging and dropping on the chart. It is very useful and easy. Use the link in the description box below, sign up and get $10 bonus. Deposit 0.1 BTC, get $50 bonus. Deposit 0.2 BTC and get $100 bonus. Now I want to show you a very important indicator, which is the cyclically adjusted price to earning ratio, or in short, CAP ratio. It is one of the standard metrics used to evaluate whether stock market is overvalued, undervalued, or fairly valued. The metric was developed by Robert Shiller and popularized during the dot-com bubble when he argued that equities were highly overpriced. For that reason, it also casually referred to as Shiller PE, meaning the Shiller variant of the typical price-to-earning ratio. For any investment, price is what you pay and value is what you get. Therefore, there are a variety of metrics that compare price to value. The most commonly used one is called price-to-earning ratio, or in short PE, which divides the price of the share by the annual earnings. Shiller PE is slightly different. It's cyclically adjusted price-to-earning ratio. We typically catch the entire cycle and analyze it. Shiller PE can be calculated simply. We just take price of the share or index and divide by 10 years. This would help us to see if the index is cheap, expensive, or fairly valued relatively to recent history. In simple language, Whenever the Shiller PE ratio of the market is high, it means market is overvalued, and returns over the next 20 years will likely be poor. In contrast, whenever the ratio is low, it means the market is undervalued and the returns over the next 20 years is likely be good. This is what Robert Shiller had to say recently. The market is very overpriced. And then he also said that bad time in the market ahead. Well, it's not a secret. You do not have to be a rocket scientist to see that Shiller PE ratio is very, very high, especially right now. It's currently at almost 32. The only time it was higher is during 2000's dot-com bubble. Even in 1929 stock market crash, Shiller PE ratio was lower than it is today. Just imagine that. It was at exactly 30, and now it is about 30. Does this mean that we are in the biggest bubble in the history? Well, let's see what one of my favorite investors, Howard Marks, has to say about the current market state and what we should expect next.
You say, Howard, that one of your strengths as an investor is knowing how to think about the future probabilistically, effectively evaluating the odds against available information. Howard, I want you to think probabilistically. We've started a new year. We've started a new decade. Does now strike you as a good time to be investing?
I would say probabilistically it is not, because if you look, the market's been up for 11 years. It's quadrupled off the low. We're in the longest bull market, the longest expansion in history. Profits are not rising. Stock prices are. It's what we call a liquidity-driven rally. That means it comes from people having a lot of money to spend. If you put those factors together, it doesn't mean that the market's going to go down tomorrow, but it does mean that the odds are not, in my opinion, in the investor's favor.
Is that to say that now is the time, Howard, to be a contrarian? Because as we both know, the economy is growing at a reasonable clip. Forecasters say the odds of a recession in 2020 have declined. Stocks, as we witnessed last week, brushed off, right, the threat of Iranian hostilities and surged to a new record. And of course, high yield spreads keep edging closer and closer to a new post-crisis low.
Right. Yes, well, the way I would phrase it, Eric, is that this is a time to have less risk than you did 3 or 5 years ago. You know, 3 or 5 years ago, we were here, and now we're here. All things being equal, if we're here, we should have less risk than here. And I don't know whether we're going to go over the cliff tomorrow or continue straight up to the sky, but the odds are less in the investor's favor, in my opinion, than they were 3 or 5 years ago.
That investors often make the mistake of overlooking what you call the proposition,
right.
Which in gambling is effectively overlooking the odds.
Yes.
Now, we know how catastrophic it is to overlook the odds.
Right.
In gambling, just talk to somebody who bet on a football game and didn't look at the line going in.
Right.
Can I translate that as buying regardless of price as a recipe for disaster?
Absolutely. You know, my book, Mastering the Market Cycle, which came out a year and a quarter ago, we talked about it. If you go in the index, you can look up no price too high. And there's a lot on that subject. And I think that no price too high is the ultimate sign of a bubble, of a widespread error. And it's, as I say in this memo, it's not what you buy, it's what you pay for it. And any given stock or other investment can be good or bad. Bad if it's expensive, good if it's cheap.
I'm going to ask you a this time is different question.
Yes.
And make reference to a chart, which I hope we can bring up, of Microsoft. Microsoft's stock price relative to Microsoft's price to earnings ratio. So the price to earnings ratio you can see in blue, and the stock price is the white line. And the point I'm trying to make here is that at any given point, Howard, you could have said, wow, Microsoft is awfully expensive, too rich for my blood, I'm not going to buy. But what the stock price demonstrates is, regardless of the valuation at which you bought Microsoft, the stock kept on going up. Right. Is this time different?
Well, you know, Eric, the price always matters. The price if the price is 10 or 20% higher than it should be, that may not be enough to turn it into a bad proposition. I talk in the memo about the Nifty 50, IBM and Xerox, Kodak, and Polaroid.
Back in the 1960s.
50 years ago, they were so expensive that they made good companies losing investments. So the price can be too high. If you looked at that chart, you see that there was a while when the price was ahead of the earnings, and as a consequence, a long period in which the stock didn't do anything. But maybe it's not so much too high that it turns it into a bad investment.
Howard, we've spent some of this conversation talking about indexing. Most people know indexing through a three-letter acronym, ETF.
Yes.
The other three-letter acronym that we've come to accept and, if not understand, in the post-crisis period is the CLO. Yes. The CLO is a direct or indirect consequence of post-crisis bank capital rules. We're going to be hearing a lot from banks over the course of the coming week, Howard. Is the credit market, in your opinion, better off or worse off without the bank capital that used to fuel it?
No easy answer. We're better off. We, as lenders, are better off because it's a bunch of competitors we don't have. But if people hear, oh, direct lending is great because the banks are inactive, if too much money rushes in as a consequence and tries to invest too aggressively, then that's bad news. So, we have to take account of all the considerations, not merely the bank's reticence.
Does it feel to you like too much money has rushed into direct lending?
I would say so.
Let me know what do you guys think about the current state of the market, and what do you think will happen next. Leave your thoughts in the comment section below, hit that like button and subscribe.